Welcome. We will be shooting today from Jefferies office in New York City. With me today is Jeffrey Greenip. Jeffrey, it's a pleasure. Can you maybe give a short introduction?
Oh, thank you, Nicola. Jeff Greenip, 17 years at Jefferies, and I run our global financial sponsors group.
Since we're here in beautiful New York, what's your favorite coffee spot?
Nobody else knows about it, but it's a surprise. It's the Jefferies cafeteria.
What's your typical order?
Pretty boring. My coffee order I like to keep simple and fast. Black coffee.
Good choice, good choice. Hey, Jeffrey, you've been in investment banking for the last 3 decades. What are the biggest changes that you have observed in private equity?
Without question, the biggest change is just how competitive the industry is today. We see private equity going narrower and deeper to focus on sub-verticals that 20 or 30 years ago we didn't even know existed. So because it's so competitive, they're looking for every advantage they can gain on their competitors. And that ranges from going deeper and narrower to leveraging operating initiatives that enhance or add value post-acquisition. AI is a good example of that.
Jeff, at the end of last year, there was a lot of optimism in the market. Everyone thought 2025 will be the year in terms of deal activity. Until now, we haven't seen this uptick really. When do you expect deal activity to rebound?
Well, you're right. Our expectations going into the year were much higher for a variety of factors, and they haven't materialized. That said, we're only at the end of May, so there is still an opportunity. And what we have seen, what we can measure, pitch activity has materially improved. So we see backlog growing materially, which obviously at some point is going to come to market.
Yeah.
But we've also, in just the last 2 to 3 weeks, we've signed 10 deals with sponsors.
Wow.
So we're pretty optimistic that the second half will be much more favorable from an economic condition standpoint, from a financing standpoint, as well as we just expect more activity in the second half on the M&A side.
That sounds promising. And then, so at Gain.pro, we conducted research on the top 100 US investors. And what we see is there is a huge concentration with the top 10 investors actually holding about 30% of EV. Do you see the same? Do you see more concentration? Why do we see the concentration to start with?
It's an astute observation, and we would agree with the observation. In part, it's a function of what the exit path is for a large cap or a mega fund versus middle market and lower middle market. The sponsor to sponsor M&A transaction becomes more and more difficult as these companies get bigger and bigger. So what you have is essentially a massive aggregation of enterprise value in those large cap funds. What's the most likely exit path? IPO. The IPO market for the last 3 years has been below average for a number of IPOs that we've seen. We're optimistic, though, that the IPO market will be part of the solution there. We think there are a lot of high quality companies that are planning on going public, many of which we're working with. So we're optimistic the IPO market will continue to improve into the second half of this year.
That's good to hear. If we now move into a more sector-specific view, currently in the US, around 50% of assets, PE assets, are either in TMT or services with 30 and 20% respectively. Do you expect a shift in the years to come?
We're bullish. First off, technology is in every sector. So you could argue TMT is much broader than just its vertical alone. And clearly AI is impacting a lot of companies outside the tech sector. Business services has been a great vertical for sponsors because it has great free cash flow, relatively recession resistant, and the sector has had a strong strategic buyer or sponsor buyer. So the exit path has been a lot easier. So no, we're very bullish those two sectors. In fact, we have more MDs dedicated to those two sectors. And then I would say industrials is number 3. And within industrials, there are a number of sub-verticals that we're very bullish on.
Very interesting. What are these sub-verticals?
We can't tell everyone, but I will share with you. It ranges from logistics and transportation, aerospace and defense, which clearly has seen an interesting resurgence. Auto aftermarket. Business services falls within our industrials bucket because it can touch industrial services, industrial tech, which is a very exciting area where you see the convergence of tech and the industrial side of the business.
Interesting. Thank you for sharing. Now, I would like to address with
anything
you.
For a free subscription to Gain.pro. So, yeah.
I appreciate it. Now, let's address a big elephant in the room, holding periods. So in the last 5 years, holding periods went up from a good 4 years to a good 5 years. What does this mean for the PE business model?
Well, first, we got to recognize PE started as a 10-year investment horizon. I would argue that's not a meaningful move. And if they continue to grow a business, it actually just enhances the multiple on the original investment, multiple on their capital. It's no longer an IRR game. It's actually a multiple on their investment. So 4 to 5 years, if the companies continue to grow, and what we are seeing is, yes, the exit has been delayed, but the sponsors are putting a lot more behind the operations side and growing the business. We're seeing EBITDA margins move up materially. They're also now introducing AI initiatives, which clearly are exciting. And the sponsor playbook for adding value using tuck-in M&A has never been more at a premium. And we're seeing that. And with the capital markets still open, they can debt finance a number of these tuck-ins. So that's highly accretive to their equity investment.
Interesting developments. And as you mentioned before, a lot is happening in the private markets. There are also some innovation that's taking place. Is there something that is a bit overhyped these days?
Sounds like you're asking me to say AI is overhyped, and I'm definitely not going to say that. I'll tell you what's underhyped first. The retail phenomenon that is taking place, and many of us, my clients, who follow this day in and day out, and we hear about them all the time. The retail phenomenon going on right now. If you look at how retail is so underrepresented, the alt space, and then within alts, private equity, we are very bullish the private equity class. Clearly, that's how I built my career. So knock on wood, I got another 30 years doing this. But we're very bullish the retail phenomenon, and the value add that private equity brings to the table continues to be differentiated versus what we're seeing in the public equity arena.
Nice.
Overhyped. I would say what could be overhyped is the fact that private equity will not continue to perform. The fact that private equity is too competitive. What we've seen time and time again, and it's a great thing about New York City, it's a great thing about Wall Street, we innovate and we adapt. We have seen markets come and go. We're always coming up with creative ideas. The private equity universe is the best at adapting, and their value add proposition, if anything, I would argue, is more enhanced today than it was 30 years ago. So it's overhyped that private equity is an asset class that is on the 9th inning versus the 1st or 2nd inning.
Jefferies is using Gain.pro with multiple teams across the US and Europe. What are you using Gain.pro the most for?
We find Gain.pro incredibly helpful because, as you know, M&A is our core product. And in fact, sell-side M&A. The data and insights that Gain.pro provides, we believe, gives us an advantage when we're identifying and then marketing opportunities through our M&A processes. So first and foremost, it helps us identify companies, and then second, it helps us execute on those M&A mandates.
That's wonderful to hear. And then, out of personal interest, if you weren't in investment banking, what would you be doing?
I got to go back in the memory banks. All right, let's see. Astronaut. Who didn't want to be an astronaut? And in fact, one of the great things about being a banker is you get to meet astronauts. So a ton of respect. More near term, coming out of college, I wanted to go into the Foreign Service. I'm embarrassed to admit it, but I had never been outside the country until college, and it was really after college. So what better way to see the world than the Foreign Service? What I quickly learned, banking is the best way to see the world. So I love my career path, and it's given me an opportunity to see the world, work with friends who are in different cultures, different countries throughout my career has been incredibly rewarding.
That's wonderful to hear. And
Which part, astronaut or foreign service?
That investment banking.
I missed my path. I had too many cavities, so I would never make astronaut. But oh well. A little too much personal information there.
No, but happy you found the job that you really love doing.
Thank you.
There is one more question that's burning inside me, and that is, Jeff, is it destiny? Jeffrey by name, Jefferies by nature.
Well, I'll tell you the biggest advantage. My parents don't know anything about Wall Street. They now know when they see Jefferies, that's the firm I work with, and they're now rooting for Jefferies all the time, and they're so excited when they see Jefferies and the momentum that the firm has achieved over the last 15, 20 years. They still haven't met Rich or Brian, but someday they'll have an opportunity to meet them because they clearly are big fans of Rich and Brian and what they've done, and the fact that I've been able to enjoy a really fun and rewarding career at Jefferies with many more years to come.
That's great to hear. And then, final question, who shall I speak to next?
That's a great question. On the business side, what gets me excited about private equity are all the emerging managers that have started their funds, that have left some of these larger funds, and they're now going back to their roots in the lower and middle market. I have several friends who've started firms that I would love for you to meet at some point. On a more interesting point, I think what people are doing with AI can be really fascinating. I think meeting some of these tech gurus who aren't on Wall Street, but who have applications that I think are going to dramatically change our industry. Those are some potential candidates. And I definitely think you should meet Rich and Brian at some point.
Sounds good. Well, wonderful. Jeff, thank you so much. And let's connect towards the end of the year.
That sounds great. Thanks, Nicola.